All right, thank you, Guaranteed Rate. And we are going to record this evening for folks who may want to come back later and view the presentation. So, hey, thank you, Guaranteed Rate, and hello, everyone, and welcome to Texas First-Time Homebuyers class, where we will cover the 5 big mistakes to be aware of when buying your first home. And my name is, my team and I are excited to have you here. My name is Mortgage Mack. And hey, let's start with something fundamental, right? And it's, what is the definition of a home buyer? And I think that's really, really important because, there are some caveats associated with that definition that might meet your needs. And a person purchasing their first residential property who has never owned a home, or a person who has not had ownership interest in a property in the last 3 years. So you could have owned a home 4 years ago and still be a first-time home buyer today. In addition, an individual who is displaced homemaker or single parent is considered a first-time home buyer if they had no ownership interest in a principal residence other than a joint ownership with a spouse during the preceding 3-year time frame. Cool? So let's get started. So, how are you feeling about buying a home? Are you feeling stressed? I get stressed about owing money. How about are you maybe feeling uncertain about, what the cost might look like, down payment, closing costs? Drop me a note in the chat session and let me know that you're listening. And I'd be concerned about having to owe so much money, or concerned maybe about whether or not you qualify, whether or not you're going to be pre-approved. And what I would say, I get nervous about owing a lot of money. And hey, do you feel anxious? And if you do, that is normal. It is a normal reaction to the unknown, especially something as complex as financing a home. And what I can share with you, that the best way to manage these emotions is to do what you're doing this evening, is to get educated so you can be prepared for the process. And we're going to talk this evening about how to be prepared. So I believe that if I can educate you, I can empower you. And if I can empower you, then I believe that your experience buying a home will be one that is meaningful to you and to your family. And, one other caveat, I can't say enough about how important it is to buy. And because what I've done and what I've seen for 30 years is, but more specifically post-COVID, I see more housing insecurity post-COVID than I've ever seen in my 30-year career. And what does that mean? That means I see hardworking folks with good credit and money saved find it very, very difficult to find something that is affordable for them and their family. And many of them waited and waited. But we can't turn the clock back. But what we can do is make different decisions now. So here are the 5 mistakes that can cost you money that we are going to cover this evening. Mistake number 1, unaware of down payment assistance. Mistake number 2, not having a loan approval before you make your offer. Number 3, using the old saying is, banks lend money to people who can prove they don't need to borrow it. Tell me if you believe that to be true if you've ever been to your bank and asked them to borrow money. Number 4, buying directly from a builder without a realtor. It's like going to court without a lawyer. Number 5, skipping the home inspection. And we're going to move along. Submit your questions in the chat session. We're going to have 2 Q&As. We're going to stop halfway through and at the end, and I'm going to open it up to all of your questions. And hey, my name is Mortgage Mack. That's first name Mortgage, last name Mack. And if you don't believe me, just go to Google, #Mortgage Mack. And while you're there, check out my I think I got 99 5-star reviews as of this week. And hey, I've been in the mortgage business for over 30 years. I grew up in Orlando, Florida, and a small town in Louisiana. And I genuinely believe after 30 years in the business, I have a responsibility as a federally licensed mortgage loan originator to serve the public. I'm a father, I'm a granddad, I'm a husband, former guide to blind athletes in both triathlons and marathons, and I'm also vice president and leader of Team Mortgage Mack. So what are the steps to home ownership? And now I'm going to try to slow down a little bit because I'm sort of excited. And I just had a nice cup of tea. Well, knowledge is power. And I can't say enough about how important it is to just be as knowledgeable as you can, specifically about your responsibilities as the buyer. Next, get pre-approved. I put a link in the chat session for a free, no obligation, one-on-one session with yours truly, and I'd be delighted to help you map your journey. I hardly ever say no. What I say is yes, or hey, let's put together a plan to make you successful in the future. Hey, once we're pre-approved, we're going house hunting with our real estate agent. And if you don't have one of those, let me know and I'll refer you one. Finally, moving into your dream home. Mistake number one, unaware of down payment assistance programs. And as a top national landlord guaranteed rate, we have dozens and dozens of down payment assistance programs. And we actually have some that may not be available to other lenders in the market because we are considered well, actually, I think we're the number 2 lender in the United States presently. But here's what I would share with you. A lot of people in my industry, they don't like to do down payment assistance. They won't bring it up. They won't mention it to you because they're a lot harder to do internally as a lender if you don't do them regularly. And I'll give you a great, for instance, I just had a couple buy their first home, and I can honestly say, and they would tell you, had it not been for Mack, we would have never owned a home. They were referred by their real estate agent to a lender, and clearly the lender did not like doing down payment assistance. But the lender didn't do any work with them up front. And they just looked at their application, they looked at the income, didn't visit with them, didn't do an income analysis, a payment analysis, a cash to close analysis. They wrote a contract on a home, on a dream home. I was dreaming of their home. It was on a lake in it's not in East Texas, but in East Houston, where yeah, hey, I grew up fishing. And but they were told by the mortgage lender, the loan was denied. They were told by the mortgage lender that they didn't have enough money. And so out of desperation, they called me after they spoke to another real estate agent that I was affiliated with. And, the solution was really easy. They just needed down payment assistance. But unfortunately, they lost out on the home. And they had to settle for something different. So let's look at some of the down payment assistance programs, okay? So here's some examples of down payment assistance programs we offer here. We offer the My First Texas Home, which is a program that's affiliated with the Texas Department of Housing and Community Affairs. Offers down payment assistance for conventional FHA, VA, and USDA loans, and we're going to cover that momentarily. Here's another favorite of everyone, Texas Home Heroes for it's a loan program for teachers, civil servants, nurses. There's a special purpose credit program that just came out this year with just grants up to $8,500. And that's can be a lot of money. And what's different about this program is it's not necessarily based upon where the home is located or what your income is or is not. It's based upon where you live currently. Here's another one of my favorites. I've done lots of these this year, but the down payment assistance is limited to $3,000. And another one of my favorites is mortgage credit certificates, but really difficult to find those today. And we offer some of the local down payment assistance programs that you find through your city and your county. Here's a real story example of, and as a matter of fact, it was the last couple that we talked about. They had a purchase price of $243,000. The minimum down payment was $8,505. They had to pay what we call an upfront mortgage insurance premium, and we were able to get them down payment assistance in the amount of $5,000. Now, if you look at that, of $12,150. And if you look at that, the down payment required is only $8,505. But we gave them down payment assistance of $12,150. And so they had an extra $3,645 left for their closing cost. So there are 4 basic types of mortgages that we're going to talk about this evening. One is FHA, conventional, USDA, and loans for honorably discharged veterans or active service duty personnel.
Worry you don't have the funds to buy your first home? Well, don't lose hope until you've checked out all the many programs and resources that can help. Like FHA loans, USDA loans, VA loans, Fannie Mae loans, Freddie Mac loans, the FHA Energy Efficient Program, Freddie Mac Home One, the Chenoa Fund, Community Seconds, and the FHA 203K program. Then there's the National Homebuyers Fund Diamond Program, the VA Renovation Program, Fannie Mae Home Ready, Freddie Mac Home Possible, and even a federal penalty waiver for buyers who tap into their IRA account. Not to mention all the many, many other programs on the state level. And the best way to get a handle on these resources, just call, text, or email your guaranteed rate loan officer today.
Yeah, that's a really good video. But as you can tell, look, there's lots and lots of programs out there. And we offer almost as many that she could list, but we're only going to cover the 4 that we talked about this evening. And so let's start with FHA. So some of the benefits associated with the FHA program is the down payment is 3.5%. And so that would be $3,500 for every $100,000 in sales price. And we will do 3.5% subject to approval down to a 580 credit score. We'll actually, in today's world, we'll do a FHA loan with 10% down with a credit score subject again to approval. With a credit score as low as 500, FHA does offer simpler refinance options. If for some reason you close on your loan now and interest rates go down at some point in the future and it makes sense to lower your payment, FHA does have lower mortgage rates than some conventional loans. Conventional loans, the interest rate is driven primarily on credit score. And when you start getting under a certain credit score, the interest rate can grow exponentially on a conventional loan. Really, really like FHA for this reason. Higher debt to income ratios are accepted on FHA, which is also just a real challenge today, especially post-COVID, when prices have gone up so much versus pre-COVID. You can pick a 15-year fixed or a 30-year fixed, and there's even an adjustable rate. Don't normally recommend it, but if you're out there and you think you're only going to be in a home for a certain period of time and you'll be selling it at some point, maybe that makes sense for you. FHA is available on most down payment assistance programs. And hey, another major caveat for FHA is that the seller can pay up to 6% of the sales price towards your closing costs. But it's negotiable. So I want you to think about that. If I gave you 5% in down payment assistance and the seller's willing to pay up to 6%, you might not be coming out of pocket with much, if any, money. But I can tell you that if we want to negotiate with the seller to pay the balance of any closing costs after the down payment assistance, got to be pre-approved. Got to be. So conventional loan. A conventional loan is a home loan that is not insured by a government entity. It is available through or guaranteed by Fannie Mae and Freddie Mac. Maybe you've heard those terms before. And it offers down payments as low as 3% versus FHA is 3.5% and 5%. However, the debt to income ratio requirement for conventional is limited to a maximum of 49.99. Now we have our USDA loans. Great program, but it is a government insured loan. It does not require a down payment, but it is very restrictive on the location of the property, on the geographic location of the property. This program is designed for rural me try to say that, rural housing. It has limitations on the median income, limitations on the family size, and like I said, is very restrictive regarding the geographic location, very restrictive regarding debt to income ratio. Next is loans for our veterans, and VA loans are for current service members and honorably discharged service members, and it does not require a down payment, does not have private mortgage insurance, and typically has lower interest rates than other products. If we have any veterans out there, please let us know, and so that we can say hi to you and honor you. I have a son that you served in the Marine Corps for 13 years. Like I said, the VA is the best program if you can qualify for it, period. And it offers lower interest rates, and it offers enormous flexibility as far as the debt to income ratio and qualifying. So, hey, let's just do a little trivia right now, and we're going to stop for Q&A in just a moment. So I'm going to ask for your participation. So let's start with, and I'm going to tell a story behind this because I actually had this happen recently. And what can or cannot be used for down payment and closing costs? So here is, give me a yes or a no. Can personal loans be used for down payment? What do you think? Yes? No? Shawana, what do you think? Angie? Dwayne? Thanks, Dwayne. You're Dwayne. Yeah, you know, the answer to that one is no. You cannot use personal loans. How about gifts from relatives? Yeah. Yeah. You can use gifts from relatives. But we do have to document it. So we have a form letter that we use. And if you're going to get a gift from a relative, don't take any money. We have a procedure to follow to really just keep the paperwork from growing exponentially with documentation to prove the transfer. Let's try another one. It's all right, Joanna. Stocks and bonds. I think that's a foregone conclusion. What do you think? You can use stocks and bonds for down payment. How about this one? Loans or credit cards? No, that's right. Angie, Mariella, Shawana, no loans on credit cards. Loans on credit cards are a lot like personal loans. Not an option. 401k, you can use your 401k. Yeah. Yeah, for sure. I like this one, cash under the mattress. What do you think? Give me a thumbs up, thumbs down on that. No, no cash, not at all. You'd have to find a way to get that into a bank and let that season for 90 days if you had cash. Down payment assistance? Absolutely. Absolutely. How about IRS tax refunds? What do you think? Yeah. Yeah. So no personal loans. No loans on credit cards. No cash under the mattress. And here's why I bring it up. I had a young man early in the year, got a contract on a house, started processing his loan. My team asked for an updated bank statement because we had rolled over into a new month. He sent us the bank statement and there was a $5,000 deposit. And when we looked into the deposit and asked him where it came from a personal loan. And thankfully, he had a relative that could give him the difference in a gift because we could not use that. And thankfully, we were able to successfully find a solution for him. But there are instances, and I've seen them happen, where it becomes a real major challenge, and to find a solution for challenges such as that. So let's stop and do a quick Q&A. And hey, for those that weren't here earlier, I was telling a few jokes that I'm not so sure were all that funny, but I'm going to try a new one. So then we'll do Q&A, and while you put your questions in the chat, a guy walks into a bar and orders a round of drinks for everyone, and he announces, you know, I just made my last mortgage payment, and we're going to celebrate. And someone else said, hey, congratulations on paying off your mortgage. And another, and the man says, oh, don't get me wrong, I still owe them $400,000, but today's payment was the last one I'm ever going to make. Kind of funny, but really isn't, right? So tell me if you have any questions. Let's drop them in the chat session. Here's a common question. What is DTI? Does anybody know what debt to income ratio means? Well, yeah. Is it best recommended to wait to buy a home once interest rates have gone down? Mariella, I don't believe so, because I believe that rates, even if rates go down, prices are going to go up. Insurance is going to go up. And I believe you should lock in the price. Yeah. What is the average credit score that is needed? You know, I would say for a conventional loan, 620, for FHA, 580 or higher. I'm in my home with FHA loan. I have 16 years left with my mortgage and I need to refinance. Can you help? Yes, I can help you refinance that. What I would encourage you to do is book an appointment. I'm going to drop a link to my calendar. Let's book an appointment and grab your mortgage statement. And if you can share your mortgage statement, we'll take a very comprehensive look at refinancing. And the only reason you would ever want to refinance is, well, there could be more reasons, but the primary reason is, hey, can I save money? And I believe I have a very specific way that I help folks analyze the amount of savings so that we can be sure that it is the right decision for them. Let's see, is it recommended to wait to buy a home? No, I don't think so. I think that, you know, COVID has proven that prices are not going to go down. And rates have improved compared to where they were in October when they were at a maximum of 8%. Look, I wouldn't have bought a home then. But I can tell you that rates have fallen to, you know, the mid sixes, maybe even to the upper fives, and it's ideal. And the only way that I see interest rates going back down to the level that they were at, based upon my 3 decades, I can't believe I'm saying that. I'm going to color my hair next time. Is there's got to be some sort of catastrophic event. You know, the last one was COVID. And, you know, it was like going to be the end of the world. And so, you know, the federal government didn't have anything to do but to lower interest rates to try to keep the economy moving. So, Shawana, did I answer your question in regards to credit scores? 620 for conventional, but a 620 on a conventional, that's just for qualifying. I would suggest for conventional, you probably need, you know, a 700 or above. And for anything under that, we would more than likely do FHA. Balance is 70,000. Thanks, Samsung. I really, you know, would need to look at all the variables associated with your current mortgage to figure out whether or not it makes sense for you to refinance. Here we have a question from Nicholas. How is DTI factored when there are 2 people on the mortgage? So we combine the 2 incomes and we take the housing plus all the debts of all the parties on the loan. So we divide the house payment and all the debts into the combined income of the 2 people on the loan and come up with a percentage. And generally that percentage, let's say, can vary on a USDA to a maximum of 41. So if you had 2 people on a loan with a combined income of, let's say, $1,000, then, you know, the maximum house note and all other debts, including credit cards. I mean, debts, not utilities, car insurance, credit cards, student loans, car loans, plus the mortgage payment could not, in that instance exceed 41% for USDA. However, for say a FHA loan subject to approval, you could maximize the debt to income ratio or the calculation of the house payment plus all other debts divided into the mortgage payment cannot exceed 56.999999999 into infinity. At 57, done. Done. So does that answer your question, Nicholas? Please drop me a yes. Great, Juana. Is there any programs for single moms in buying their first home here in Texas? Well, I'm not sure if you were here for us, Mariella, but the answer to that is there isn't anything that I'm aware of that is specific to single moms, but there are lots of down payment assistance programs that are available to you as a first-time home buyer. And I can also say if you by chance are a single mom as a result of a divorce where you owned a home with that person, then you would be qualified as a first-time home buyer. Does that answer your question? Please drop me a yes. Great. Thank you. Thank you. Let me know, are we any more questions? You're very, very welcome. All right, let's move on. Mistake number 2, not getting pre-approved. Let me hold on to the table here because my biggest challenge is every week, every month, every year, for a long, long time, is the biggest challenge I have with helping buyers get to the closing table is helping them get all their documents together. And, you know, the pre-approval process compels you. Great. Thank you, John. Thank you, John. The pre-approval process compels you to get your documents together. And I can tell you, I just did a loan for a couple and I begged them. I'm like, hey, you know, let's put together, nah, we want to wait until we find the house. Then they found the house, we made an offer, and we won the offer. and Lord knows they were not tech savvy. And you know, the documentation that we needed required them to develop some technological skills, such as, hey, they didn't even have online bank accounts, so they weren't sure how they would, you know, they shredded all their bank statements. They didn't know, you know, nobody gets W-2s anymore. They're on your online profile. And so look, and it was just a super challenge. And what you'll do is if you get pre-approved, the first thing you'll do is you'll take a lot of the stress out. I believe the time is coming is in the real estate market that agents are going to be reluctant to look at what we normally do for folks that don't put their documents together. We do something called a pre-qualification versus a pre-approval. And we're going to talk about that here in a moment. But think about it. If you're selling a home and I come to you and John Doe over here comes to you, I'm pre-approved, John Doe's not. John Doe offers you maybe more money, but I'm pre-approved. As a seller, which option are you more likely to accept as a buyer? The pre-approved or the person that's just pre-qualified that you're going to have to wait upwards of who knows how many days to even figure out if they're qualified? I think that most people would choose the pre-approved buyer.
I can't do this anymore. I can't. I give and you take. When I ask you to do something or even fix something for me, you just ghost. But oh, when you need money, you're all over me like all stocky and weird. This is so not working anymore. I need my space. So whatever this even is, it's over. Wait a sec. Does this mean you're not renewing your lease?
That was good, wasn't it? Yeah, that was good. So, hey, who wants to fire their landlord? Who wants to break up with their landlord? Huh? So we're going to talk about the 3 C's. Oh, I need to fix that. Forgive me. So the 3 C's for approval. And the first one deals with credit and credit scores. And Nicholas, I'm going to answer your question here in just a moment. So the 3 C's deal with credit, capacity, which is up here, but we're going to talk just about credit for now, and credit scores. And I'm sure you've heard the term FICO credit score. I can tell you that there are lots of math. All the FICO score is just a mathematical algorithm. And there are lots of mathematical algorithms disguised as the original FICO. We, in the lending industry, in the mortgage industry, use the original FICO model score. And really all it does is it's a mathematical algorithm that analyzes your past and current credit history, spending habits, and rates a person's ability to repay future debts. A credit score, or a FICO score, includes timely credit payments, the amount of debt that you owe, the number of credit accounts currently open, and number of credit inquiries. Now, a FICO credit score can range from 300 to 850. I saw an 835 recently, but traditionally 580 and below is considered a poor credit score. 580 to 669 is considered fair. 670 to 739 is considered good. And 740 to 799 is considered very good. I consider, and most people in my industry consider, 740 and above to be considered excellent. So next is capacity. And what we're talking about with capacity is the ability to service the debt, which deals with debt to income ratio, which deals with your question here, Nicholas, which I'm going to answer momentarily, and also it deals with the asset. So the question is when they calculate DTI, is it based on your monthly student loan payment or the total amount of the student loans? That is sort of not a tricky question, but there are a multitude of different answers to that question based upon your situation and based upon the type of loan that we do. So if there is a monthly payment listed on your credit report, we are going to use the payment that's listed on the credit report. If there is not a payment listed, we're generally going to use a 0.5% of the balance. So that is what? For $1,000, we're going to, hey, I took math in Louisiana, what, $5? $50? $50. And so, it really just depends upon your situation. Now, there's another question about AIG. What all AIG are required? I'm not quite sure I understand that question. You might want to maybe reframe that. I'm not sure what you mean by AIG. But let's talk about income. And we look for income stability. And generally, 2-year work history is what we would regard as stable. However, if you're salaried or if you're hourly with a guaranteed number of hours, 40 hours a week, and the 2 years can be a much shorter time frame. If you're a teacher graduating right out of college with a teacher certificate and going to work in that industry with a salary, I can use that income, right? Let's say you're a nurse and fresh out of nursing school, going to work at a hospital, I can use that income even though you have not been on that job for 2 years. However, here's where we get into, and I see challenges for all the time. And for professions where maybe you're paid commissions, maybe you're paid bonus income. I'm seeing a lot of variable income that I didn't see because I see a lot of employers that are hiring folks and not guaranteeing them a certain number of hours. That's considered variable income. I also see temporary folks that are temporary employees and definitely self-employed people. And if you meet, or your income is commission, bonus, variable, temp income and or self-employed, 2 years. Just like, there's just no way around it. You know, you got to go out there, you got to, you know, do your work. And what we do is that makes the income is then at that stage usable, but we calculate that income and we use an average of the last 2 years to figure out how much you make. And I'll give you a great example. A self-employed person recently, he made like, okay, 160,000 in 2023, but he made 70,000 in the year before. So I have to average with that 70,000. And he was thinking we were going to qualify him based on 160,000. And that's just not how it works. So 2 years. And we talked about debt to income ratio and the requirements associated with that. And next is collateral. And what's the collateral? The collateral for the loan is the home. And we as the lender require an appraisal, which is an unbiased opinion of value based on licensed appraisers' analysis of the property's condition and similar values of similar homes in the same neighborhood. U, which is elective, we're going to talk about here shortly, an inspection, and which very, very important. But that also, part of the collateral, that includes the title, which is you know, a legal document that outlines your property, I guess, in words, and then the survey. And all of those will, appraisal, title, survey, inspection, all of those fall underneath the collateral section. And finally, the fourth C. This is the one that I have the biggest challenges with. Is, hey, there's a series of documents that we send to you. They have to be signed, and they have to be signed in a timely basis, or guess what? We can't process your loan. We can't close your loan. Some of the other challenges are all the financial documents to support your income, to support your assets. So we're talking bank statements, and I have folks that send me bank statements, and it might be an 8-page statement. They send 5, and they say, well, the other pages were empty. It doesn't matter. This is our biggest challenge. It's a good idea if you go to my website at mortgagemack.com and you click on the spyglass, I'm sure that you can find a checklist there of documents that you need to begin to put together so you can prepare for the pre-approval process. And all required TRID documents. I have folks tell me all the time, well, I'm not going to sign that. I had a lady last night, God bless her. She's like, well, I'm not going to sign this because my daughter, you have my daughter listed at 25 years old and she turned 26 over the weekend. So, that's a little overkill, but hey, I went back and changed it, but I'm not going to resend those documents. But I can't start processing her loan unless she signs them. So those are some of the biggest challenges we deal with. And look, early on in the process, like there's nothing binding. There's nothing binding in our relationship until you get to the closing table, sign those documents, and there is an exchange of money at that closing table. Okay, so let's talk about approval versus pre-qualification. Hey, loan approval is a process where we take your application. We actually, via third party, verify your credit, verify your income, verify your assets. And we put all of that together in an electronic file and submit it directly to an underwriter. Now, who is the underwriter? What does an underwriter do? An underwriter is the person at our company, and he or she is the only person at our company that has the authority to approve a loan so that the loan can close. So, they're the bosses. How about that? A pre-approval will help you. It will help you win in the marketplace. It will help you beat out other buyers that may be competing with the other home. It will help you negotiate repairs if repairs are needed. It will ensure that you close on time. It will increase your bargaining power, as I mentioned, with the seller. And it will give us the ability, because and what I generally do is I generally will pick out a home that maybe you're interested in. We use it as a test case so that we can firmly define payments. define total cash to close, and it will also help us clearly identify the best program for you. All right, so let's do some to do or not to do, and we are going to move into a Q&A just shortly, and I'm going to answer all the questions that are in the chat section. But let me ask you, if the information has been helpful to you this evening, would you drop me a thumbs up, please? All right, Lo, I'm not going to talk about the to-dos because those are pretty much a given. And those are pretty much just a, hey, email us, call us, be involved in the process. I love being engaged with folks, talking to people, guiding them through this process and sharing my 30 years of experience. But I actually had this happen just recently where somebody was a school teacher, was the education industry. She was leaving school. She was closing on her home the same week. And she told somebody in the gym or something that, hey, I'm not coming back next year. I'm going to a different school district. They took it seriously and they resigned her. And we verify employment just before we close. And guess what? She didn't have a job no more. And guess what? We're not closing. And so don't quit your job. And don't make any large purchases during the transactions. Don't change bank accounts. Don't make large deposits. Don't close any credit cards. Don't move money in between accounts, right? While we're in the process. Don't make any major financial decisions during the loan process without consulting with me. I had a client call me today. He's like, hey, Mac, I have this credit card. I need to pay it off because, if I don't, they're going to charge me interest. And is this going to impact my loan? And the answer for him was no. But I appreciated the fact that he picked up the phone to call to make sure that it did not have a detrimental impact. And look, don't miss payments on any of your debts. Don't charge your credit cards up because we do what we call a credit refresh. Don't apply for credit because we're going to know. And because we are going to do what we call a credit refresh approximately 3 days before closing. And if there's been any activity on your credit report, we're going to know. And, at the last minute, you're going to be having to explain that. So if you can grab a screenshot of that, grab a screenshot of that. Okay, mistake number 3, using your bank. I love this. I love this. Banks lend money to people who can prove they don't need to borrow it. Hey, banks and credit unions are slow to process. And that's the big deal with them. And, if the process, you have deadlines in that contract that you have to meet. If you don't meet those deadlines, it can cost you money. And look, you're only maybe potentially one of thousands of people will know you by first name. And sometimes, large banks and credit unions have stricter guidelines that will not cater to the specific needs of the consumer. And look, my job is I don't get paid till you find a home and you're happy. And but most people at these credit unions and banks, they operate on a different pay scale. And if you don't close, it's no big deal for them. And I can tell you, I've experienced this with my own personal family, coaching them in other states that I'm not licensed in, and that's what they find is that they're not willing to go the extra mile to find solutions for the people that they serve. And like I said, the process moves extraordinarily much slower versus ours, where we use speed as a basis for helping you win in the marketplace. Banks and credit unions, hey, you know what? Today reviews matter. It just does. And you can, I don't know about you, but I check reviews of almost any service that I use today. And my compliance department made me take down the names of the banks that were listed here. So, but here's what I can tell you is, like I said, if you check me out on Google, I have a 99 5-star reviews on Google. I have a couple of dozen on Facebook, have a couple of dozen other places for a total of about 130 5-star reviews. And I can tell you that when I start a new relationship, my goal is to educate you, empower you, so that you have an experience with us that is meaningful to you and your family, because I'm going to ask you for a 5-star review. That's all there is to it. Okay, mistake number 4, buying directly from a builder. Hey, what can I say? It's an industry that is not regulated in the state of Texas. Anybody can be a builder. You can just get a set of business cards and declare yourself a builder. And it's truly not that simple, but hey, it's an industry that is that a lot of people have had bad experiences, and not everybody. So I don't want to stereotype builders in any way, but here's what I can tell you. They are genuinely interested in selling that home. They're not generally interested in your welfare. And they will take your earnest money. And I can't say enough about how important it is that if you're going to look at new homes, even if you're going to go out and just look, take a realtor. Take your realtor with you. And or if you go alone, tell them, I have a realtor. I'll have my realtor call you. Okay? Because what happens, and I've seen it happen before, folks will get engaged with the sales rep, and all of a sudden they're writing a contract. They haven't been pre-approved. They wrote a $10,000 check, and now they're not getting their money back because they can't qualify for the house. And the builder is going to have no mercy. They're going to keep the $10,000. So never buy a new home from a builder. Hey, a lot of times they offer closing cost assistance, and sometimes that is enough to draw people in. Right now, they're offering lower interest rates. And you know what? I can tell you, if it's a reputable builder, they have really good reviews, and you have your real estate agent, might be a great opportunity for you. So I'm not saying don't buy with a builder, but make sure that you have your real estate agent with you when you do. Let's see, your real estate, like I said, your real estate agent will help you understand the builder's contract, because the builder's contract is designed for the builder's benefit. The real estate agent works for you, and the sales agent represents the builder. Your real estate agent is knowledgeable about what to look for during the inspections throughout the process, if it's a new home being built from the ground up, and the final walkthrough. I have a quick question here, and does anybody know what earnest money is? Drop me a note if you know. And here I'm going to tell you a true story. Actually, I've had 3 people in the last year that I've met that bought new homes without real estate agents, use the builder's lender, and lose their earnest money because the lender didn't do the appropriate due diligence up front to see if they qualified. Builder went out and built the home. And then when the home was ready, they couldn't close because they didn't qualify. And the builder kept their money. They didn't get their home, and they weren't out on the streets, but one lady was closed. She had to beg her landlord to let her back into her rental property. And thank goodness he hadn't leased it yet. Otherwise, she and her family would have been homeless and in a hotel somewhere. So the question is, what is earnest money? And this is slightly off this topic, but earnest money is money that you deposit with a third-party entity, in this instance, the title company. The title company holds that earnest money and the purpose of the money is to show good faith to the seller. And what you're doing is you're telling the seller, look, I know you have your home for sale for $400,000. I'm going to deposit with the title company 1% of the sales price to show you that I'm serious about buying your home. And that money stays there and then when you close, it gets counted towards your down payment. But here's the critical thing, is if you don't meet the obligations in the contract with the seller or with the builder, they can keep your money legally. Okay. So beware when enticed to use the builder's mortgage lender. True story. I had, interest rates were going up in 2022. I had a couple, they were building the home from the ground up. It was going to take 8 months for the home to be ready. And wow, mortgage rates were going up like every day. And And it was like March or April of 2022. No, March or April of 2023, because interest rates peaked October 2023 at 8%. And they started the year at like under 4. I mean, so it was a big deal. It was very dramatic. A lot of people just lost their earnest money, didn't close, because, you know, if you go from 4% to 8%, that's a big jump in the payment. And what happened is a lot of the builders, lenders will not offer you to lock your loan while the home is being built. And we do. And I had a couple that they were talking to the builder's lender. The builder's lender said, hey, we'll only let you lock 45 days before your home is built. And they're like, well, that's 5 months from now. And so we locked their loan. We locked their loan in the 4s. And when they closed in November of 2023, they were in the 4s and rates were in the upper 7s. And let's just say that they invited me to their housewarming party, hint, hint. And I was the honored guest because everybody in the neighborhood was paying over 6% and some paying 7%. Okay, so it's a good question to ask. You know, a lot of times builders own the mortgage company. And so there is an interest in the two parties to make money because that's what they do. And, you know, a lot of times the lender will, or the builder will offer incentives, but what really is happening in some instances, not all, is the builder, like I've had builders ask me this. They're like, hey, can I tell the buyer that you're going to pay the title policy or that I'm going to pay the title policy, but you really include it in the loan and add and make the interest rate higher and you pay it? No, I won't. Because it's intellectually dishonest and it's lying to the consumer. And I just won't do it. And so that is one classic example of what builders and their mortgage companies do. I had one recently, hey, they were paying $15,000 worth of guys' closing costs, but charging 7.625 in the interest rate when interest rates were 6%. Unbelievable. Unbelievable. Hey, you know what I would do is I would Google search the builder, Google search the builder's lender, and I would read the reviews, and I would call my realtor. Okay, mistake number 5. We're getting close to the end, and we're going to open this up for Q&A. The objective of the home inspection is to uncover structural or safety issues. The inspector will inspect the roof, plumbing, electrical, exterior, all the exterior. Will note any safety issues. They will inspect the foundation, and they're going to cover everything in the house. And I could tell you that as a first-time home buyer, don't be alarmed. Really sit down with your real estate agent and review it, and they're going to help you understand if some of these items are really detrimental to your ownership and from a value standpoint long-term and or safety. Now, we don't see the home inspection. We send the appraiser out. The appraiser acts as our eyes and ears, and the appraiser is not an inspector. But if he does observe things that might be conducive to the home not being livable, or things that may be issues as it relates to safety, and or like, hey, post barrel, I have some tree limbs that are on my roof right outside, and you know, I'm not good on ladders because if I fall, it's not going to be good. So my lawn guy is going to, you know, trim them back tomorrow, but that would be a for instance where the appraiser would look at that and say, hey, you know, you leave those branches on that roof right there, and that's going to, you know, the combination of that organic material on the roof is going to create a weak area in the shingles, and it's going to be a problem later, and it will cause the shingles to rot. And so that is a classic example of an instance where even the inspector would make a note of that, but the appraiser would definitely require it to be fixed. So some other issues to think about. You could unknowingly inherit costly repairs. That's another good reason to get a home inspection. You could lose negotiating power during the option period if you were not to get a home inspection. And look, you need to be aware of all the safety concerns that might exist in the home. I had a couple at the beginning of this year. They called me, they were referred to me by their realtor, and they were just literally up in arms. They were told by a mold remediation company that their home, the walls were full of mold, and literally overnight their home value was cut in half because the only people that are going to buy that house are going to be investors, and because nobody can live in it. They were told they needed to move out. So they owe more than the house is worth currently. They can't live in it, so they have to go pay rent somewhere, and all because they just didn't do a home inspection. And so I can't say enough how critical that is. And their solution was they contacted me, and I introduced them to a friend who does home improvement loans. We went out, found a contractor for them, and we got a home improvement loan and fixed the mold, but it cost them $55,000. So you risk inheriting structural, non-structural defects such as the foundation, electrical, plumbing, and hey, getting a home inspection could help you forecast future repairs that you can budget for now. And because what I would share with you is that, hey, it's still competitive real estate market out there. It's not as much as a seller's market as it was during COVID. But hey, I see my buyers negotiating repairs generally in the form of closing costs. They'll fix it after closing seems to be the dominant theme of what I'm seeing today. And but you just really got to get that inspection done if at all possible, and you have the budget for it. You should prepare about $1,000 to $1,500 for that. And so if you're buying a home as a new home buyer, a couple of things that you should be aware of, that you should be prepared for financially. Home inspection, like I said, it could range anywhere from $500 to $1,500. There was a home that were telling me, but it's a much larger home. The inspector was going to charge $4,000. And my buyer is like, do I really need to do this? And you don't. It's an elective. But what you do have to be prepared to pay is an appraisal. We do require the appraisal fee to be paid up front when you have a contract. And we do require the credit report to be paid up front when you have a contract. And if you don't know what an HOA is a homeowners association that governs the community. What they really are is a nonprofit government entity. They're not a government entity. They're a nonprofit private entity performing the functions of a government entity. They're charging people $300 to $400 before closing for their paperwork that your lender needs, the title company needs. And look, and it's just a cash cow for homeowners associations. So I would encourage you, you're going to be prepared to pay out of pocket earnest money, John. Generally, that's 1% of the sales price. So $400,000 house, you're going to have $4,000 you're going to deposit with the seller to show good faith. Then you'll need a couple of $100, $200 to $500 for what we call option fee, which is a check that you write the seller that gives you permission over a certain number of days to perform an inspection. And during that option period, if you find any defects in the property, you can terminate the contract for any reason and get your earnest money back, but not your option fee. And then once the earnest money is binding with the contract, and once you paid your option fee, the lender requires you to pay the appraisal, credit report, which typically is going to run $700. I saw appraisal today ran $625, but generally we're going to quote $700, and then $50 to $150 for credit report. But hey, don't forget that HOA certification. Man, that's like $300. And I paid $300 for my first car 50 years ago. Not 50 years ago, but 45 years ago. Just an old, just beat up car, right? And so $300 for me is like a lot of money, and still today. And I can't believe that homeowners associations get away with charging people $300 for a 2-page report. Are you kidding me? Huh? Highway robbery. So, hey, what are the next steps? And, if you're comfortable and you believe you're ready, you can start by applying at mortgagemack.com. Or, hey, click on the QR code. I'm going to drop my calendar into the chat if you want to schedule a one-on-one with yours truly. And the next, let's get you pre-approved. Let's go home shopping. It can be fun, can be exciting, and it can be rewarding. And people get in trouble when they're not working with the right team, who's giving them the right advice on how to do this the correct way. And the correct way is always to prepare in advance. And so that, that it's not stressful. And I can tell you that I deal with stress every day, and it's always related to buyer's paperwork. And so, how do you feel now? Drop me a note. Tell me how you're feeling. Maybe feeling better? Maybe relieved? It's with a good team, this can be a meaningful experience for you and your family. Let's see. Hopefully you're feeling more confident than you were when you got here. Good? Thank you, Shawana. Feel more informed. Thank you, John. Hey, feeling cool? I don't look so cool, but hey, I do have some shades over here, but how you feeling? Tell me. How about encouraged? I hope I've encouraged you. I hope I've encouraged you to, wherever you're at currently in your life, to see this as a priority for you, for your family, so that you can develop wealth and housing security in your life. Because I can tell you that, oh my goodness, I had lunch today with somebody that, man, I trained them 25 years ago. I'm showing my age again. There you go. 25 years ago. And it was amazing how fast the time had flown by. And it just felt like yesterday. We were working in the same office in Katy, Texas, and she was a young loan officer, and I was training her and a couple of other people. And now she's gone on and been immensely successful as not just a homeowner, but as, property investor. And it's great to see. But the point I would make is that time flies. It goes fast. And I can tell you that you'll look back and you'll say, you know what? Besides your children, besides your grandchildren and your spouse, I believe one of them, and maybe even your wedding day, one of the most memorable events should be buying your first home. And that's it, folks. Congratulations. So let's do a little Q&A. What do you think? I'm going to scroll back up in the chat session. I had a couple of questions that I didn't answer, and I want to address those. So what is AIG? AIG, adjusted gross income. In taxes, what is adjusted gross income? So adjusted gross income, I believe, is the income after you've deducted your standard deductions or itemized deductions. So what you have is you have the gross amount on your W-2, but you don't actually pay taxes on that amount. You pay taxes on, hey, if you have children, you get a deduction. If you have a spouse, you get a deduction. For just yourself, you get a deduction. And hey, if you're a single mom, you might get some, or a head of household, you might get some deductions. And if you're a business owner, you might get some additional deductions. And so what that number is it's the net number that you actually pay taxes on. Cool? Samson, drop me a note if that's cool. Will Zelle, Cash App, Venmo, or any other type of funds transfer affect your buying home process? I would suggest that it really just sort of depends, right? And these are all new platforms that, if 10 years ago I'd have said no, but today I would say yeah. I mean, I've used Zelle to document rental payments, so I know it can be used, but it's just going to be a matter of what it's used for and how I can connect the memo. So if you're making payments for like your rent using Zelle or Venmo or a Cash App, hey, put in the text part, put rent for January 2024. And especially if you plan on buying a home, it's a good idea to just organize that outflow of your cash so that if we do need to verify something like rental history, or I give you, for instance, I've had folks that didn't have any credit scores. And so if you don't have any credit scores, then I have to verify maybe insurance payments for your auto, utility payments. I can verify mobile phone payments. I can verify, I tell you this is the truth. 25 years ago, 26 years ago, I verified a bar tab for somebody. And that is no lie. And in those days, 26 years ago, not everybody carried a credit card. So, hey, you still had bar tabs out there. But, that's when you might want to have to verify something in a Zelle or a Cash App or a Venmo app. Let's see, when is the deposit required in the process if you pay one? Well, John, if you're referencing earnest money, that earnest money deposit is required within 3 days of you signing the contract and making your official offer to the seller. And that deposit is required. And there are no sellers out there unless it's somebody that personally that is going to accept no deposit in good faith for a contract on their home. They're just not going to do that. But remember, John, be prepared. Earnest money, option fee, HOA certificate, appraisal, and credit. Okay, I'm going to say it one more time. Be prepared for earnest money deposit, option fee. Those are paid when you make your offer. Next is the inspection. And you have a set number of days to do the inspection, and it's right after if the seller signs the contract. And that means you generally are going to have 5 days, maybe 10 days to get your inspector out there and inspect the home to make sure that there's nothing that would prevent you from wanting to purchase that home. I encourage my buyers to pay for the appraisal when they pay for the inspection. And here's why. So I want you to think about this. If you're a seller and I'm working with, and I have a buyer, and okay, the buyer's name is Shawana, and Shawana's pre-approved with me, and she's prepared. She's got her documentation in order, and I'm coming in and making an offer on your home. Shawana's making an offer on your home. Where am I going with this? Forgive me. And so she makes a deposit for earnest money. Okay, let's say $4,000, pays an option fee of $500. She has 10 days to get the inspection done. A lot of buyers, they say, like, I don't want to pay for the appraisal until I do the inspection. And I'm of the mind, no, don't do that. Take the risk, pay for the appraisal. Get the appraisal done during the option period. Get the inspection done during the option period. And if you're not already pre-approved, get your pre-approval during the option period. And guess what's going to happen on day 10? The mortgage is done. The only thing we have left to do is whatever the seller is responsible for. And I have my buyers, I've saved buyers upwards of $9,000. And what happened is we overbid the house to beat the competition. The sellers had no idea that we were going to do the appraisal during the option period. And then during the option period, you can cancel for any reason. You can terminate. And so we did the appraisal. The appraisal came in $9,000 low. And the seller thought that, hey, you agreed to pay me this. Well, yeah, I did. But my lender suggested that I do the appraisal during the option period. The house didn't make value. And so I'm going to terminate if you're not willing to accept my lower offer now. And the seller accepted. So very, very powerful way to become an aggressive buyer and leverage the lending in the process. Okay. Let's see what we got here. Feel more informed. Let me make sure I didn't miss any of those early questions. Let's see what we got. I recently took out a loan for dental work and I'm playing catch up with that account. Should I wait until I pay off the loan first to initiate the home buying process? You know what I would do? I think it's, hey, look, we only do a soft pull. And so it's not going to impact your credit negatively. And so if you want to apply at mortgagemack.com, let's take a look at that and see where it's at, right? Because you can't go on a journey, and this is a journey. You can't go on a journey and begin that journey and map that journey out without knowing where you're at. And if anything else, what we'll be able to do is determine where you're at now and put together a plan of action for things that you need to do to be positioned to qualify and become a home owner. Let's see what we got here. Does the down payment assistance program qualify for all the costs you are listing now? No. And you got to have some money up front. And because the down payment assistance doesn't come into play until you get to closing. And that's, generally a couple of weeks, 4 weeks into the process for us to get to that stage. So the answer to your question is you should have some money, even if it's a gift from a relative. Get a gift from a relative. Even if you have to borrow the money from, say, a 401k. But here's what we can do is you can be refunded for some of that money. I closed a loan just 2 weeks ago where they made a $4,500 deposit for earnest money and option fee, and they got $1,700 back at closing. Does that help? Let's see, my landlord requests me to pay him in cash, so the only verification for rental history I have is an ATM withdrawals. What can I do to support my rental history to properly document? I don't know, Mariella. I think that you should fire your landlord. And, here's what I would share with you. As it relates to rental history, we don't verify rental history only unless it's absolutely necessary. So I wouldn't let that stand in your way of applying because you know what? Might not even be necessary. I can tell you that somebody that's been in the industry for a super long time is the way it used to work is you couldn't buy a home until we verified that you paid rent on time for 2 years. But it's not like that anymore. And rarely do I ever have to verify rental history. So I don't know that it would be that big a challenge in the mortgage process. And what I encourage folks to do, let's go apply, let's make an appointment, we'll spend some quality time together and map out a successful plan for you. Okay, got it. This helps. Are the fees included with the earnest? Are those fees included with the earnest money deposit money, or I'm not quite sure I understand that question, John? Are those fees included in the earnest money? No, they're all separate. So the earnest money is separate. The option fee is separate, all paid separately. The earnest money gets deposited with the title company. The title company is an independent third party. They hold that money, does not go to the seller. But the option fee does. The option fee, it goes directly to the seller. Seller cashes that check, belongs to them. The HOA fee goes to the homeowners association. That's a separate entity, separate check. Appraisal, separate entity, separate person. Inspection, yeah, you're getting this right. You'll be writing either lots of checks or doing a lot of wires or a lot of cashier's checks. And so, no, they're not all included as one. They are all paid separately. Hey, thank you, thank you, thank you. So let's see what else we got. No more questions? Hey, you know what? If you enjoyed this, I'm going to drop my bird's eye link into the chat. And if you would go write me a review on Google, that's where I have most of my reviews. Please, if you I'd be delighted to visit with you. If you'd like to schedule, you're very, very welcome, Mariella. Schedule a one-on-one free consultation. I'd be delighted to do that with you even before you apply. And look, I can tell you that if you don't call me, I'm gonna be calling you this week. And but let's see if we got any more questions. One more second. Let's see what I got. We covered DTI. We didn't cover points. I can tell you points, if you heard that term, all points are upfront interest. That's all it is. It's upfront interest that you pay at closing for the benefit of a lower interest rate for the life of the loan. That's all it is. And there are something called a temporary buy down, but look, the only way it ever makes sense to do a temporary buy down is if the builder is paying for it. Okay, trust me on that one. So if you see, you know, the term buy down, the first question you want to ask is it temporary or permanent? And you know, if it's temporary, it can be a really good, you know, stopgap measure for a short period of time. But I personally like the permanent buy down. I like the idea of having a lower interest rate for the life of my loan versus a temporary interest rate that's only going to be fixed for year 1, year 2, and it's going to be at a higher interest rate, sort of like an adjustable rate over the remainder of the time frame. So, and with that, I would say I really do appreciate you being here, and thanks for attending. If you would write me a review, I would be super, super grateful, and I look forward to visiting with you soon. Have a great evening and be safe. Bye-bye.